Well, hello there. I'm Gemini.
All right, let's talk about something that gives almost everyone a little bit of anxiety. Those giant stacks of old receipts and tax documents. You know, the ones shoved in a box in the basement. Well, if that sounds familiar, you are definitely in the right place. Today, we're going to tackle that paper tiger head on. We're going to get crystal clear on the Canadian rules for keeping tax records, what you need to keep, how long you've got to hang on to it, and, why any of this actually matters.
So here's how we're going to break it all down. First up, we'll hit the big one, the 6-year golden rule. Then we'll dive into the exceptions, because that's where things can get a little tricky. After that, we're talking practical stuff, paper versus pixels. We'll even cover the right way to destroy old records. And to wrap it all up, I've got a super simple cheat sheet for you so you can remember all the key points.
Seriously, are you just drowning in paperwork? I think we've all been there. What does the Canada Revenue Agency, the CRA, actually expect you to keep? And for how long? Is it 5 years, 7, 10? It can feel like a total mystery. And what's the one piece of paper you might throw out that could cause a huge problem down the line? Well, we're going to clear all of that up starting right now.
All right, Section 1, the 6-year golden rule. Let's get right into it. This is the bedrock, the foundation of pretty much everything we're going to talk about today.
So what's the magic number? It's 6. 6 years. That's the general rule from the CRA. You need to keep your records and all your supporting documents for a full 6 years. But, and this is a huge but that trips a lot of people up, the clock doesn't start ticking the day you file your taxes. No, it starts from the end of the last tax year they relate to. So let's say we're talking about your 2023 tax return. You need to hang on to all those records until the end of 2029. That's a key detail to remember.
And this right here, this quote gets to the absolute core of why you need to keep those records. It says you have an obligation to prove that every figure on that return is correct, reasonable, and legitimate. What does that mean in plain English? It means the burden of proof is on you. The CRA doesn't have to prove you're wrong. You have to prove you're right. Think of it like this. Your tax return is your claim, and your records are the evidence. If the CRA ever audits you and you don't have the evidence, you've got nothing to stand on.
Okay, so what are we even talking about when we say tax record? Well, really, it's anything and everything that backs up the numbers you put on your return. For income, that's the obvious stuff, like your pay stubs and T4s. But if you're a freelancer or have a side hustle, it's also every single invoice you sent out and the bank statement showing those deposits. And then there's the expense side. We're talking receipts for everything you claimed. Medical expenses, charitable donations, that new printer for your home office, your mileage logs if you drive for work, even your RSSP contribution slips and GSD/HST returns. Basically, if you use the number to calculate your tax, you need a document to prove it.
All right, Section 2. Now, just when you thought you had it all figured out with the 6-year rule, we have to talk about the exceptions. And you're going to want to pay close attention here, because these are the situations where that 6-year rule goes right out the window, and you could need to keep things for way, way longer.
Okay, let's break down these common exceptions. First up, late filing. If you file your return late, that 6-year clock does not start from the tax year end. Nope, it starts on the date you actually file. So if you were, say, 2 years late filing your 2021 return, you have to add 2 years to your shred date. Simple as that. The second one is huge, objections or appeals. If you're arguing with the CRA about something, you have to keep all the related records until that whole mess is completely, totally, 100% resolved, plus any extra time for more appeals. So don't even think about touching that shredder until you have the final word.
Now, this one catches so many people off guard. We're talking about property, things like your home, your cottage, stocks, investments. For these kinds of assets, the 6-year rule only kicks in after you sell or get rid of them. Let me give you a perfect example. You buy your house in 2010. In 2018, you do a huge renovation. Then you finally sell it in 2035. Guess what? You need to keep the original purchase agreement and all those renovation receipts until 2041. Yeah, seriously. Why? Because those documents prove your cost base, which can save you a ton of money on capital gains tax when you sell. So keep that folder somewhere safe.
For anyone out there who's a business owner or director, listen up. The rules get even more specific for you. If a corporation shuts down, dissolves, you've still got to keep its records for 2 years after it closes. If 2 companies merge, the new company inherits the record-keeping job for the old ones. And this last one is a big one for directors. You can be held personally liable for a company's unpaid taxes, like payroll taxes. Your best and sometimes only defense is having pristine records to prove you did your job properly. Think of those records as your personal liability shield.
And just a few more special cases to round things out.
If you're handling an estate or a trust for someone who has passed away, do not destroy a single piece of paper until you get what's called a clearance certificate from the CRA. It's an absolute must. Also, the CRA can just tell you to keep your records longer. They'll send you a formal letter. But this last one is wild. If you have transactions involving payments to non-residents, the CRA has no time limit to go back and reassess you. That means, you guessed it, you have to keep those records pretty much forever.
Okay, Section 3. We figured out what to keep and for how long. But now for the big question, how do you keep it all? We're living in a digital world, so let's dig into what the CRA says about paper versus pixels.
So the CRA makes a really key distinction here. Think of it as born on paper versus born digital. If a record was originally a physical piece of paper, like a receipt from a store, you've got two choices: keep the paper or scan it into a good quality digital image. Now, on the other hand, if a record was born digital, like an e-invoice you got by email or a PDF bank statement you downloaded, you have to keep it in its original electronic format. Printing it out and then deleting the file is a big no-no. That paper printout is not a valid substitute in the CRA's eyes.
So, you want to go paperless and scan everything? Awesome. But you can't just snap a quick blurry photo with your phone and call it a day. The CRA has rules. Your digital image has to be a totally accurate and clear copy. All the information has to be there, nothing can be cut off or unreadable. Basically, if an auditor looked at the scan, it should be just as good as looking at the original paper document. As long as you meet that standard, you're good to go, and you can shred the paper. And look, if you're going the digital route, backing up your files is not optional, it's absolutely critical. Your laptop hard drive will fail one day. It's not a matter of if, but when. So you need a backup system. Get an external hard drive, use a secure cloud service. Better yet, do both, and store that backup somewhere safe, off-site, and make sure you can actually restore the files from your backup. A backup file that you can't open is just, well, it's just digital garbage. It's completely useless.
Now here's a fascinating little detail. Where do you have to keep all these records? The law says they have to be at your place of business or your home in Canada. And this is where cloud storage gets really interesting. The CRA's position is that if your data is sitting on a server in, say, the United States, it's not in Canada. So technically, if you use a cloud provider whose servers are outside the country, you're supposed to get written permission from the CRA. Something to think about, right?
All right, Section 4, the art of destruction. We spent all this time talking about how to keep records. Now let's talk about the satisfying part, getting rid of them. But hold on, you can't just have a bonfire. There's a right way and a very, very wrong way to do this.
Let's say you want to destroy some records before that 6-year mark is up. Maybe you're moving and just want to declutter. Well, you can't just do it. You have to formally ask the CRA for permission. You fill out a form, it's called a T-137, or you can write a letter to your local tax office. And then you wait. The key rule here is you do not touch a single thing until you have that written permission back from them. I mean it. Don't do it.
And here's exactly why you need to wait for that permission slip. If you jump the gun and destroy records early and then, bam, you get an audit notice, you're in trouble. The CRA can simply say, no proof, no deduction. And just like that, they can disallow all those expenses, which means you're going to owe more tax, plus a pile of interest and penalties. In really serious situations, it can even lead to prosecution. Honestly, it is just not worth the risk.
Okay, that was a lot of information, I know. So for our final section, let's boil it all down into a simple, straightforward cheat sheet. This is the part you can screenshot or jot down to keep handy.
Okay, let's do a quick recap. Your personal tax stuff? Keep it for at least 6 years. But here's a pro tip. Hang on to your notices of assessment forever. They're like your tax report card. Business records? 6 years after the tax year is done. For property documents? Remember, it's 6 years after you sell. Estate records? You wait for that official clearance certificate from the CRA. And if you're in a fight with the CRA, you keep everything until it's over and then some. Simple, right?
And I love this quote because it's a perfect reminder of what really matters. No matter how sophisticated your accounting software is, no matter how beautiful the reports it generates are, none of that replaces the original document. When an auditor asks for proof, they don't want your summary report. They want to see the actual original receipt. The proof is always in the source.
So, at the end of the day, it all comes down to this one question. Are your records a liability, a ticking time bomb of stress sitting in a box? Or are they your best defense, an organized toolkit that protects you? The choice is totally yours. My hope is that after this, you feel way more empowered to turn that paper tiger into a well-organized ally. Thanks so much for tuning in.